Don't stop.
Welcome to This Week in Real Estate with Jonathan Harmon. Listen in as him and other members of the J Harmon Home Team speak about all things real estate with local experts here in the Middle Tennessee area. Be sure to check out jharmonhometeam.com for more information and how to get in touch with our amazing team. Welcome to the show.
Yes, welcome to the show. Happy New Year, Woo! 2024.
Woo!
It's like 2023, only another year after that.
Yes, that's exactly how that works.
That's exactly how that works. It's amazing, right?
And I saw a great reel the other day, and it was this girl, and she's standing there, and she's like, hey, how old are you? And she says her age, whatever, and she's like, well, it's been 4 years since 2020. And she's like, no, it's been 2. I'm like, no, it's been 4 years since 2020.
4.
Yeah.
Yeah. See how that works?
Quick math check.
We have a phrase for that here in this neck of the woods, and that is, bless her heart. Yeah.
But I mean, no, 2020 feels like it was like
yesterday.
Yeah, like last year, the year before. No, it's been a solid 4 years.
COVID was almost 4 years ago.
Yeah. Wow. Everything in 2020. I mean, it wasn't just COVID. We had, the murder hornets.
I forgot about those.
There was like so many.
The Nashville tornado.
Yeah, that was the year that like you started having like the bingo calendar. Like this month it's this month it's this. Like last year you had the submarine thing and a few other things that popped up. But
that is crazy.
2020 was nuts.
That's so weird.
It was. Hey, but I still look back at that, and there was a lot of really good things. I mean, like, dude, I spent so much time with my kids, and we just hung out and learned and did some fun stuff. And, I don't know. There's some things I kind of miss.
I'll be honest with you. I feel like, we're fortunate that we didn't lose anybody that was super close to us or anything. Mm-hmm. And so coming out of it, in the moment, I was aware that I was getting some quality time with my family and the children and stuff that I wouldn't have normally gotten. And that as events started coming back and we started getting back into that pace of life that we're in now, and there's moments when I'm like, man, I'd love to just go back to that, where every night when I get done with work, I might get done with work at 8 p.m., I might get done with work at 5 p.m., but whenever I get done, I'm just going to go out.
Head to the fire pit.
Down to the hall and go out to the fire pit, fire up the grill, and just there's no like, hey, gotta go run to this networking thing. Hey, gotta go. I mean, I missed all that stuff, but I also appreciated the pause.
Yeah, it's interesting. There's all kinds of things we can get into on that. That's a whole podcast up there. But anyway, so welcome to the show. This is This Week in Real Estate. I had to look and make sure that's what we were doing. Jonathan Harmon with the J Harmon Home Team, powered by Keller Williams, with one of my best buds here, Mr. Bryan Nale over at Primis Mortgage. And so normally this would be the time where I run your little commercial thing. Do you want to run the commercial or do you want to give the commercial?
I mean, if you run it, it's compliance approved.
So we're not running it then. What are you talking about?
No, my name's Bryan Nale. I'm with Primis Mortgage. I'm a local mortgage loan originator. And
Nail Your Mortgage.
We've got a great team. You can go to nailyourmortgage.com for more information. And then, if there's anything that I can answer for you in the home financing space, I'd love to do that.
Beautiful. And then there you go. The end. Okay. So last week you were out of town on Thursday, and I went to I was your sub for a networking thing, and it was one of those networking things where everybody has a minute commercial or whatever that they stand up and do their pitch. And you sent me a text. I didn't tell you this yet. You sent me a text message. And you're like, hey, you can read this. And I was like, yeah, I'm not going to do that. And you should have assumed that. You know that, right? And,
at least I gave you something.
Yeah, that's right. And I did mention a couple of the things that you put in there, and we're going to talk about those today. But what I did is I stood up and I said, listen, Bryan sent me this. I'm going to pretend that I'm him, but what I'm really going to do is tell you why I use Bryan Nale. And so that's what I did for your commercial. And I think it was good.
I heard you did a great job.
It was.
So
I was there.
Yeah, Trent was there. Yeah. And the bottom line is you're a guy that works solely on commission, but yet you take the time in an environment right now that quite frankly is challenging. And if you have an opportunity to do a deal, you want to do the deal. But you also have the compassion and the care for people to truly do what's right for them. Yeah. And sometimes, a lot of times, especially in this environment, what's right is to do nothing. And that giving that advice directly impacts your wallet right now, and at a time where your wallet has already been impacted. And, that's hard to do. That's hard to not say, oh, yeah, we can do that, and here's how to do it, even when you know that that's not the best thing for their long-term financial health. And that means a lot to me. I tell people all the time I spend more time talking people out of houses than into them. And that's what I want my partners to do.
At the end of the day, my integrity is important to me, and I think it's important that people have that kind of perception of me as being a professional and giving good advice. And I want to be an advisor through this process, and not just necessarily for that particular mortgage, but also I've been exposed in my career to all different aspects of investing and banking, and I'm only licensed to talk about certain things, but I just, in real life advice, and just kind of recommending who they can talk to have the right conversations about why this might be a strategy that I would use or whatever it might be. But just giving people sound advice is important to me.
And I think that's the most important thing about any professional is I don't want the professional that I'm sitting across the table from to know everything, right? But I want them to know where to get everything. And it is significantly more valuable to me to get a direction than it is to get an answer, if that makes sense. I can arrive at my own answers, but I need the direction and I need help from people that know. So, and you do that, and you do a great job with that. And that's why I've used you as a mortgage lender, and that's why I will forever, until you mess it up, refer you to other folks, which he won't.
There's always that.
Yeah, I'm not worried about that at all. That's why I can joke about it. All right, so today we're gonna talk mortgages. The story for the last really probably 2 years at this point has been mortgage interest rates. Kind of going back, we came out of an environment that the rates were so low, they were artificially held there, and the market forces were saying no, 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 and the Federal Reserve was saying let's do this, and you and I talked, and me and lots of other folks talked for felt like several years, where it's like, I don't know why rates are this low right now. I don't know how long that we can sustain this. We saw prices jumping on houses, 20 to 40%, depending on the submarket, for a couple of years in a row.
Yeah.
So, I mean, everything was saying this is dumb, and now we hit this. It feels like we hit this wall, kind of a nice little roller coaster, little kiddie coaster. We've had a pretty wild ride.
Yeah, we ran head first into that wall.
Yeah,
and I mean. And people forget that rates have been low for a long time.
Like,
they had been in the 4s and in the 3s before COVID. And then I think it was 2018, they kind of got close to 5 and everything just froze. Everything stopped. And so
it was right around Christmas time. I remember it.
And if you put that in perspective, in 2022, we just forget 5, let's go straight to 6. Like it was just like power through that. And
I honestly don't remember in 2022 a rate in the 5s. I remember 4s and then 6s and then 7s.
It was like that. Yeah. It was like that. And so that was a tough year. But thinking back to the causes of why they kept rates so long, and then we can spend a long time, looking back at revisionist history, but I remember thinking, hey, it's 2021. Rates were great in 2020 because of COVID, and they needed to keep the Fed funds target rate at 0.
But did they? And see, so that's ultimately the question, right?
Well, they were going to raise them in 21, and then the Delta variant came out, and they started to. Like in February of 21, rates started inching up. And then there was all this concern about Delta and Omicron and these new variants of COVID, and so the Fed was like, okay, well, maybe we need to keep rates low a little bit longer just to keep the economy going. I think so. I think that's what got. If you look at the employment and how quick it spiked back, I think keeping the rate low was necessary. I think they could have probably started to bring it back up before they did, and then we wouldn't have had to, you think of a pendulum, you wouldn't have had to swing back so far and even.
And I think that's what I'm getting at is, do they? It feels like it was an overreaction, and my cynical self feels like it's motivated by something other than an altruistic care about
Yeah.
the health of the economy.
Yeah,
Do you know what I mean?
I do, and then we could dive into that if you want to, but
Nah.
I don't think that's the right
Nah,
conversation for right
that's
now.
a whole. That's best shared over a beer right there.
Yeah. But no, I think they needed to do what they did. They left it down there too long. That's my opinion. And that the consequence of that was this rampant inflation. And it's not just rates, right? It's what you pay for groceries. It's what you pay for hotel rooms. It's what you pay for gasoline. It's all of
Building
that.
products and so on and so on and
It's
so on.
everything. That inflation hit. So what people don't, you think about, okay, well, we got to calm inflation down. That just means you stop the growth of prices. It doesn't mean prices come back down.
It's not. Yeah.
So until you get to, unless you want deflation, which means a lot of job loss and people just don't have money to spend. So
Equity loss.
So
yeah.
these prices are here and they're not going anywhere.
Right.
So anyway, rates though, I think it's important that we talk about THDA.
Yeah.
Because man, like.
So let's do a brief history of THDA because. I've been in real estate for 14 years, and in 14 years' time, THDA has evolved several times.
Right.
If you think about it like Pokemons, right? Like we've hit several evolutions. I started with Pikachu, and it was very simple, and it was very effective, and it lit everything up, so to speak. The electric Pokemon there, right? And then it evolved a little bit, and now it got. Honestly, during the boom time, it was irrelevant.
It was.
I mean, especially in Rutherford County, and I'm sure in some of the outlying counties it still was. But in Rutherford County, from, probably 2018 until probably 2022, honestly, it was practically irrelevant. I think I had like 2 deals in that span of time that involved THDA.
There just wasn't a lot of motivation for someone to use the program.
There wasn't a lot of motivation for sellers.
There was zero motivation for sellers to accept a THDA offer.
Yes.
So where it would have benefited some people, those people who had to sit on the sidelines. And if there's been one, silver lining to the rates and going up like they have, it's that it's kind of calmed that market down to where first-time home buyers that need some down payment assistance are able to use that program. Yeah. A lot of people bought houses, and really overextended themselves. Maybe they had enough money for the down payment and the closing costs, but it really they went in that house with no reserves, no emergency fund,
and a lot of times no true insight on the problems with it because they either waived or they strongly downplayed their inspections.
I had somebody that backed out of a contract last week. There was the inspection, didn't go well. And I was like, okay, well, sometimes inspections don't go well. We'll come back and we'll see if they can negotiate it out. And it was going to be like $100,000 in work that house needed. That would have, 2 years ago, they would have bought that house because they didn't have that inspection. They would have waived it. Maybe they would have done a pass-fail and they could have failed it and walked away.
I am proud to say that I only had 3 non-inspections.
Yeah.
Everything else we made sure we got at least a pass-fail.
Yeah. I mean, that was important.
At least open your eyes.
Yeah. Just know what we're getting into. But yeah, so they're back on the market now and looking for another home. But, THDA, the biggest thing that's changing, and if you're
what is it now?
Yeah, so if you're watching this is what you need to know. You've got 3 weeks to get under contract before the change happens because it takes effect on locks submitted to THDA after February 1st. Okay. So you've got 3 weeks. And what's going to change is that the down payment assistance is going to go from 6% down to 5%. Doesn't seem like much. It's just 1%, right? But if somebody's buying a $300,000 house right now, they would get a grant for $18,000. Come February 1st, their down payment assistance would only be $15,000.
That's $3,000 they got to come up with.
$3,000 difference. So that's, if you're doing FHA with 3.5%, $300,000 purchase, that down payment's $10,500. If you're getting $18,000, that's enough to cover almost all of the closing costs. And if you get a little bit of seller credit, if you get the seller to give you $2,000, you're probably in a conversation of even maybe getting your earnest money back. Yeah. Or a portion of it back. Yeah. If you go to $15,000, now you need a much bigger seller credit in order to be able to come to that transaction, buy that house without any of your own money coming out of your bank account.
Right.
And if you're shopping between 300 and 400,000, because statewide the THDA purchase price limit's $400,000.
That's the purchase price, not the loan limit, but it's
Correct.
100%.
So $400,000 is the cap. So you can buy a house for $400,000, but the cap on the down payment assistance is $15,000.
Oh.
So if you were buying a $400,000 home, you were going to get $24,000. Now you're going to get $15,000, and you need a lot more of your own money to make this happen. You're going to have to have your own money. So if you're a realtor that's watching this, if you're in the business, or if you're a family or friend, you know someone who's a first-time home buyer and is thinking, hey, this is the year I want to try to buy a house, they've got 3 weeks, which is not very much time to get pre-qualified and go out there and find a house, negotiate it, get it under contract, and then get the contract back to the lender in time to get the locked THGA by February 1st.
Right. And assuming that there's going to be some increased activity at that, so that's going to take a little more time as well.
Right.
So let's do this real quick. I don't know that you and I have ever done this on air before, but give me 5 main loan types, right? So in the state of Tennessee, THDA, VA, FHA, conventional, which there's some subcategories there, and then USDA, right? So give me kind of a real quick rundown. What are the differences, like current rates, qualifications, any stipulations, those kinds of things?
So THDA's rates are right now 6.375% for your standard THDA. If you are
and their rate is based on bonds that they issue chunks at a time.
Right, and that's why and that's one of the reasons for their change, because people aren't refinancing their houses, so they're not getting their payments back. They're not selling their houses either, so they're not getting their money restored. So they have less money to work with. So they're trying to curtail how much they're committing.
Because historically, people would buy with THDA. They would potentially refinance. They might have extra equity, so they can move into FHA or they can move into whatever, and then they would get that large chunk of money back into the pool. Yeah.
So homeownership for heroes is awesome because if you're a veteran, you don't have to be a first-time home buyer to use THDA, and if you're a first responder or a veteran, you get a 50 basis point discount on your interest rate. So it dropped into the 5s. You're looking at getting at a rate in the 5s with THDA right now if you're a veteran or if you're a first responder. So that's a great opportunity. That's the only one I really want to quote rates on, because everything else is going to be
it moves every day,
all over the place, and dependent on the buyer.
You can still tell me though, VA rate right now is higher, lower than conventional.
VA typically is going to be pretty close to conventional, usually maybe a little bit lower. Depends on credit score.
FHA, higher or lower?
Lower
a little bit. And then USDA?
Is going to kind of run close to the FHA.
Okay.
They're all going to be pretty close to each other. The thing that makes THDA pretty cool is it doesn't matter if your credit score is a 740 or a 640, you're going to get the same interest rate.
The rate is what it is.
You have to have a 640 to qualify. And again, you could have an 800 credit score, and you're going to get the same rate as the person down the street with the 640 credit score. But because that rate is usually going to be lower than market rate, nobody really cries foul that I've got 800, I'm getting the same rate as my 640. Well, you're still getting better than market.
Yeah, you're still better than conventional or FHA. Yep.
So VA is 100% financing. If you receive any disability at all from the VA, then they waive the funding fee. The funding fee can be pretty significant. So if you're thinking about buying a house and you think you could probably get approved for VA disability and you haven't applied for it yet, just because you're just like, man, I don't, it's not a priority.
Well, and so one thing I want to throw out there is there's percentage disabilities, and a disability according to VA does not mean that you are quote unquote disabled.
Right.
It is something that a physical ailment that has happened because of your service.
And the smallest one of those levels, whatever that percentage is, the smallest percentage,
it's like 5 or 10%.
I think it's 5.
Yeah.
Will qualify you for that funding fee waiver.
Right.
So that's important.
A lot of folks is hearing loss or something along those lines.
And it may not be complete hearing loss. It could be just some damage.
Right.
So the VA is great for the interest rates are usually going to be a little bit lower than conventional. it's going to be a good program. It's got it goes off of residual income rather than a straight DTI. So I've had people with a DTI approaching 60%, 65%, but they make a lot of money, and at the end of the month, there's a lot of money left over, so they're able to qualify for a higher payment than a lot of the other programs who have just a set DTI number. That's another key differentiator for VA. FHA, you've got your standard 3.5% down payment. It's got upfront PMI and monthly PMI. It's got if you put 10% down, the PMI will drop off after 10 years on the monthly side of things. But if you don't put 3.5, if you just do 3.5%, 5% down, anything up to 10,
life of the loan,
you're going to have that PMI for as long as you have that mortgage.
No matter what your DTI
right
or your
right.
LTV gets.
And if it's the first time you're buying a house, not a big deal because you're probably going to live there for 5 to 7 years and
or
sell the
refinance
house
it
and move out, or you're going to get an opportunity to refinance it at some point to a conventional mortgage and drop the PMI. So FHA is great for your more lower to moderate credit scores. Really, up to about 720, FHA should be on the table as a conversation piece, just to compare and weigh your options of whether you're going to want to choose a FHA or a conventional loan. Conventional, there's different incentives out there too for lower to moderate income families. So if you under 80% of the area median income, you can do a home ready program, and that's awesome too. And if your loan officer's not looking out for this, and they could be making some big mistakes because the loan level price adjustments for credit scores get thrown out if somebody's doing a home ready loan. So somebody could have a 680 credit score and be under 80% of the area median income and use a conventional mortgage and get a fantastic rate because it throws all those loan level price adjustments out. That's been a positive change to conventional loans that we've seen in the last couple of years.
Okay. And then, of course, USDA, also known as rural development, you're going to be tied to a specific geographic location.
Right.
And that area has shrunk in Rutherford County. But if you're looking Bedford County, you're looking Coffee County, Warren County.
Cannon County.
Yeah, Cannon County. And even a significant portion of Wilson County still is definitely worth looking at. And it's, I would say, of all of the non-conventional loans, even during the busiest time that we had, even during those massive, feeding frenzies that we had, USDA we were still able to get through because a lot of the people that live in those areas bought with USDA. They understood it.
Yeah.
And it's no down payment. It's 100% financing. So people understood that and felt good about it.
Right.
Not like THDA where it's like, oh, well, they just don't have any money.
Yeah.
And that's right or wrong. Was the perception.
Right. Well, and USDA is going to be tighter on the debt to income ratio. And it's also going to consider, it's one of the last programs here that considers household income. Even THDA isn't household income now. It's just the income for the person on the loan. But USDA, if you've got a grandparent that's living in the house with you,
or a 16-year-old,
that's working, every person in that house that's working, they're going to need to get their pay stubs, W-2s, verify their income, and all of that's going to add up. To count against the income limit, but it doesn't necessarily help the debt to income ratio because the 16-year-old kid's not going to be on the mortgage.
Right, right. That's kind of crazy.
Yeah.
So when you're evaluating all of these different types of loans with folks now, one of the most important things that you do is get to the core of what motivates that person and what keeps them up at night, right? And from my limited perspective on your side of a real estate transaction, I feel like there's probably a handful of things, and one of those is going to be the chief motivator for any given person, right? So when evaluating this loan product versus this loan product, folks look at the total cost of the loan, right? So the upfront cost, and then also if I hold this loan all the way through maturity, how much am I going to pay out, right? It's a $200,000 loan. But at the end of it, I'm going to have paid $450 for it or whatever, right? So that's one thing that people look at. The second thing, of course, is people are extremely payment sensitive.
Absolutely.
Right?
Yeah, and they should be.
Yeah. How much does this house cost? Well, it costs $500,000. That's not what I asked. How much does it cost?
Yeah.
Well, it costs $3,000 a month. Okay. Now we can relate to that.
Yeah. And one of the biggest complaints I hear from clients is if they've talked to another loan officer or in your national, your online lenders, those big box loan operations are probably the worst at this. But they always say, they approved me for a $500,000 house. I don't want to spend more than $300. but they kept telling me that I could spend $500,000. I'm like, I'd want to have a conversation about what the numbers look like at 300 because that's where I think my budget is. And I get that all the time. So people are absolutely payment conscious, and they should be. And because what a lender tells you can get approved for doesn't mean your life won't be miserable if you take on that payment.
And I give that advice to folks when they're evaluating mortgage lenders as well, is you're going to qualify for way more than you probably want to do, right? We're
Not
willing,
always.
not always,
Some people-
but we're willing to do that.
Yeah.
But then look at what that does on a monthly basis,
Right.
and how does it cut into your lifestyle?
Well, and not every family is the same. Like if you've got 2 kids in daycare, your living expenses are significantly different than a newlywed couple who doesn't have kids in daycare yet, or a family who's already kind of gone through that and their kids are off to elementary school.
Or you've got somebody that has health concerns, and at any given moment you could rack up a huge chunk of medical bills.
Yeah.
It doesn't reflect anywhere in your credit score.
Right.
But yet that is a time bomb that's going to
possibility.
Yeah.
And somebody that, when we look at a debt to income ratio, sometimes we may do a loan for somebody that's at the absolute max of their debt to income limit, but we aren't counting the spouse's income because we know the spouse's credit's not as good, so they're going to get a better rate if the spouse isn't on the loan, but we know that there's more income. That family's going to be just fine with that payment.
Or they've got a big nest egg sitting somewhere
and I tell that to people all the time. Hey, if you feel like maybe the difference between you getting a home that you're truly happy in and just kind of settling for a home is $30,000. Well, when we look at what the payment is, if you might feel more comfortable taking on that additional $30,000 in purchase price if you are going to have $30,000 left over in the bank when you're done.
Right.
So maybe instead of putting down all of your money, keep some of that liquid as a reserve because that helps you feel more comfortable.
That's right.
With that payment.
It pushes the
knowing
safety button.
That you've got a reserve set aside.
So back in the day, I used to tell people that it was around $3.50 payment per thousand financed, right, when we had really low interest rates.
Right.
What is that multiplier now, roughly? And obviously,
I'd say roughly $650.
Okay.
Yeah. Probably about $650.
That would have been my guess. So that's good to have that confirmed.
Which is funny because guess what? That's what it was when we bought our first house.
I know.
That's kind of where we are with rates.
The difference is that the houses are, twice the price or more.
Yeah.
All right. So my favorite thing to get you fired up, the best phrase that every real estate agent uses right now, and I know you love this: buy the house, marry the house, date the rate.
Yeah.
How do you feel about that?
A lot better than I did in 2022.
Okay. Do tell.
Yeah. So in 2022, that's when rates were going up. That's when that coin or that catchphrase became real popular.
Yep.
And at the time I was like, hold the horses. Rates just got to 5. Rates just got to 6. We don't know where they're going to stop. We don't know how long they're going to be up here. So don't tell somebody marry the house, date the rate when you can't look them in the eye and give them any assurance of when they're going to be able to refinance.
Yeah, when can they break up with the rate?
Because all those people who bought at 5 and were told marry the house, date the rate, now they're like,
I'm never going to refi.
They may not.
Yeah.
They may not. Now, I feel a lot better about it right now with the Fed's indications and what the Federal Reserve is telling us they're going to do with interest rates, and we're starting to see the spread between the 10-year Treasury and mortgage rates starting to kind of thin a little bit.
Get back to where it should be.
That's what I told him to read at the Believers in Business meeting last week, by the way. But as we see that compression, we're starting to feel like, okay, we do expect mortgage rates to go down this year some. So,
but here's the reality: if you got it at 5%, 2 years ago, you did well.
You did good.
And seeing what has happened. So when is it going to drop below 5? I can't even tell you when it's going to drop below 6.
Right. But if you really stretched and you did, maybe you got sold on doing the 2-1 buy down, and now you enjoyed that payment at 3% for the first year, and then it went to 4%, and now it's going to be 5% real soon.
Because wages have also stayed relatively flat.
And you thought you were going to be able to refinance it back into the 4s before it ever went to that 5, 6, whatever
Not going to
it's
happen.
going to go up to. Yeah, you're going to have to take on that full payment now. And I think that was probably what made it the most dangerous thing, was that marry the house, date the rate, while we're setting people up with mortgages that are going to go up over the next couple of years, and selling them on that pretense that they'd be able to refinance before they ever got to that full rate. It's almost like an arm.
It is an arm.
Yeah. So that was probably like the kerosene on my angst for that phrase, was that I knew that it was being coupled with those kinds of programs. But right now I feel like, my conversation with people now is, how much should I buy the rate down? And I'm like, for over the last couple of years, most of my clients have hedged a little bit and paid a little bit in points to buy the rate down, but they didn't chase it. They didn't chase it too hard because they were hoping they'd be able to refinance and let the lower rate come to them. And that conversation now is, I'm having more and more people say, I don't even want to pay the points.
And that's where I am right now, is watching what's going on. I feel like, and it's purely a feeling, right, that we're going the right direction as far as that goes.
Right.
And so, the buying a rate down, there's a real simple cost benefit analysis to that, and it all hinges on how long you will have that rate.
Mortgage.
Yeah.
Yeah.
And so the reality is, I think that we're closer to a refi boom than we have been, obviously, in a very long time.
Yeah. The industry feels that way. Certainly. If you look at anything from the Mortgage Bankers Association, there's a lot of anticipation of that this year. What's interesting to me is, is rates fell so fast from November to where we are right now, that it kind of clouds our judgment, and we forget that a lot of the loans that we closed, because people were paying points, they're still not quite in that refi area, that space yet. But I think that over the course of this year, if the projections are right, we'll get there by the end of the year.
And my conventional wisdom thinking is that it really needs to be at least a full percentage point difference.
Yeah.
So if I'm at a 5.75, I really need 4.75 before it makes sense to pay the money to do a refi. And yes, I know that's not 100% accurate. That's just kind of how my brain is programmed. And there's a calculation with that. How long are you going to keep the loan? What's your savings going to be? And you just divide it, and there you go.
So where the break even is.
Yeah.
And if you're watching this and you're thinking, okay, well, I'm going to bookmark that information. I'm at 6.5. When rates get to 5.5, I can refi.
Not necessarily.
Not necessarily, because it might make sense for you to do that before then, or you might wait out some momentum. And if rates fall quickly, do you want to refinance too soon, or do you want to kind of wait and see what happens?
Well,
I always think,
and
if you like the rate, get it.
And if you like the house, right? So that's the other thing. You might be sitting in that house going, well, I can refinance to 5.5, but really I want to move.
Yeah.
Then move.
Yeah, then move.
Because if you're only going to stay there for 6, 8, 10, 12 months, you're not going to make your money back. You're throwing money away.
That's a great point too. But also, during that refi boom in 2020, we saw a lot of people who maybe they didn't make up a whole point in rate, but they were able to drop PMI because appreciation was there.
Sure.
And so if you've been in your house now at this point, let's say you bought a house in the summer of 2022, you don't have any plans on moving, you bought it with an FHA loan because FHA was back in 2022, and you're looking at that PMI as a percentage of your monthly payment, and you can drop that because prices have stayed fairly stable. And I mean, the math could work out for you to refinance before you can make up 1% rate too.
Yep. Well, and there's other terms as well. The last time I did a refi on a house, I was able to go from a 20-year term to a 15.
Yeah.
So I dropped 5 years off of it. So that total cost of the loan went way down.
Right.
And my payment stayed essentially the same.
Yeah.
And that was a great move for me.
Right. You're saving tens of thousands of dollars.
Yeah.
Over the next few years.
Yep. All right. So let's talk rates for a minute. Let's talk a little bit about where they've been, where they are. That, and I'll throw your disclaimer out there. We're talking just for giggles. We're talking conventional loan, 30-year, perfect credit. 20% down. Right now, no hiccups. This is a perfect world. That way we don't have but. So if we can talk on the perfect side of things, then you're going to fall in somewhere within that.
Somewhere
right?
in those. And I think that's probably going to be, without looking at paying a whole lot in points, you're going to be in those low to mid sixes
right now.
Yeah.
Low to mid, not mid to upper.
Not mid to upper.
Okay.
Low to mid sixes. It's going to be, these next few weeks are going to be pretty interesting to see where the market goes. Because again, the rates fell pretty fast. There's been at the start of this year.
Yeah, we were at 7.25 November, right?
Dude, we got to 8.
Yeah.
The rates got to 8.
Yeah.
So if you think about that, now that's a really fast decline. The only thing that can kind of that's even a bigger, steeper decline in rate than we saw in 2020 because they didn't have as far to fall. They so that's massive movement. And now there's been this year it's slid back the other direction. So rates have actually from 1.2 to now they've ticked up slightly. So will that momentum continue, and we'll see rates move back and stabilize in the mid sixes for a little while and kind of settle there? And they might, but over the broader course of the year, the expectation is for rates to fall. And if you wanted to play the fun game, we can throw a dart out there and say December 31st, this is where they're going to be.
Yeah,
I'd say they're probably that number's going to start with a 5.
By the end of this month?
By the end of this year.
Oh, okay. Okay, I was going to say, dadgum.
Yeah, no.
So here's what's fun about that is when I take that information and apply it to what I do, there are a ton of people that are just on the fence, right? Yeah. They're just waiting, seeing what's going to happen, and that might be on the buy side, that might be on the sell side, that might be on the sell side and the buy side, like they're going to do both. It just kind of depends on circumstances, but there's a lot of people that are waiting. And the logic, and I get this, is the activity hasn't been there. They're worried about prices falling off, and the worry could be they're worried about them losing equity. They're also worried about them buying a house more expensive than they could buy it 6 months from now.
Right.
2023, we don't have all the final numbers yet, but I think when all is said and done, 2023, we're probably going to see in Rutherford County as a whole in aggregate, it's probably going to be pretty close to flat.
Yeah.
Right. We had some moments where we lost some value, or where values were down. We had some moments where they came up. And understand that when I say values, what I'm looking at is what happened, right? And so the average price might have dropped, or the average price might have gone up, or whatever. But that's not necessarily reflective of what your house did.
Yeah. Are you about to get into like the price point segments? Because I feel like
there's some segmentation.
Yeah.
But then there's also, when we talk about average pricing and things like that, there's outliers, right?
Yeah.
So if I'm selling a house that's a piece of garbage, and I do nothing to it, and that's a lot of what gets sold during a given period of time for whatever reason, right? Then all of a sudden I have a group of outliers that drive my price down. Right? Or you have a new construction situation where it's the last 5 houses in the neighborhood, and they're ready to close up shop. They're not worried about their comps in that neighborhood anymore. They may incentivize the hell out of that place,
right? And
the prices drop. So and a lot of that kind of stuff, that cleanup happened in 2023,
right?
And then simultaneously, the market was in Rutherford County was highly dictated this past year by new construction.
Yeah.
And they're not going to drop their price if they're still building in that neighborhood because they can't tank their own comps.
Right.
But what we did see, they would keep the price where it was or continue to increase it, but they were throwing out incentives like nobody's business. Yeah. We'll buy your rate down for $25,000. Yeah. We'll put blinds in and fences up and refrigerators and upgrade this and upgrade that and whatever.
And that kept prices high. So when you're looking at that flat year over year, I think it's pretty. I would assume that some of those lower price points may have seen a little bit of appreciation.
Yep.
As you have THDA back in the mix.
Yep.
And you have more people who are coming in as first-time home buyers who have a chance now to buy a house.
But there wasn't very many of that inventory. That's the problem. Well, so you still had a huge supply issue.
But you also had probably even tighter supply issue on those second-tier homes where people who bought their second home and the $500,000 price point, maybe the $400,000, $350,000 to $500,000, they're home. Like they're not moving up to that next home like the cycle of home ownership before them.
That's true. I think we had more inventory there than we did in the lower price point.
Because of new construction?
Yes, because that's where new construction's still building. And not only because of new construction, but that is where more of the we got to sell the house life events happened, right? So those first-time homebuyer homes, number one, new construction is not building them unless they're townhouses.
Right.
Period.
Yeah.
You cannot buy a piece of land in Rutherford County and build $300,000 houses. No. You can't do it.
Yeah.
It's just not possible.
Right.
You can build townhouses.
Townhouses are $300,000.
Yeah, or
plus,
more. Yeah.
Most of the time.
Yeah. So that's where we were seeing that. And so that the inventory greatly affected that. But the biggest thing is that middle price point. New construction was there in force, right? But the resale stuff wasn't as much, and it's because I'm sitting here going, okay, I'm at a 3.5% interest rate. Right. I bought 3 years ago. If I sell my house right now, I'm gonna immediately move into more than double my interest rate. Yeah. Number one. Number two, because of how prices shot up, what I sell this house for, and I buy something for the same price, I'm losing
space,
losing house. Yeah.
I think that's where and those families who are like, their life events changed. They've had another kid. They've had
kids have moved out. College. Somebody died. Somebody divorced. Whatever.
They're looking up and looking around, going, "Y'all can bunk up. Y'all can split a bedroom. Mm-hmm. If families come in town." You're gonna.
Grandma's sleeping in your bed. Sorry, kid.
You're gonna go.
Not really, sorry.
You're gonna have to go to the couch.
Yeah.
They're like, we will make do right now. And I've seen that kind of some of those families that normally would have said, hey, it's time for us to go get that next house. I think in 2020 people bought a house just because they could.
Yeah. Oh yeah. Absolutely.
and now those are really driven by necessity, and that's where some of the pent up demand, if rates do come back down, and we get through a good portion of this year with rates in the fives, I think those families that they've had a kid, maybe two kids, through this cycle now, they're chomping at the bit. They are ready to go, and so. That market, and I remember this time last year we were sitting here probably having the same conversation. Mm-hmm. Hey, rates look like they're starting to come down a little bit, and then they
didn't.
They faked us out last year around this time.
Yeah.
But boy, when they do consistently settle down wherever that's going to be, if it's in the fives, I think you just buckle up, because this market, there's no easy markets in real estate. It's going to go back to a multiple offer hard. The THGA is probably not going to be as relevant. And
especially with those changes.
So save money and
that's it. I think if you have any advice for someone, it is stockpile cash.
Right.
While you're waiting, stockpile cash. Don't tap into the equity if you don't have to.
Look at your mortgage payment and what you're paying right now on your low rate, and if you think, hey, maybe by the end of this year I want to buy a house, but I'm not sure if I can afford it. Call me, call a loan officer and say, hey, what would the payment be?
And save the rest.
On this, and save the difference, plus another couple $100, because you don't want to go from a $1,800 mortgage payment to a $3,000 mortgage payment and not be able to save anymore. So try to save. If that difference is
stick $1,200,
stick $1,600 in a savings account each month. That's going to help you, because you're going to have more liquidity, more money available for closing costs, down payment,
and you know what your lifestyle is going to look like.
More reserves when you buy the house. You know what that lifestyle is going to feel like. You'll know you're ready for it, or you'll know I don't need to do that.
Yeah, that's solid advice. That is solid advice. Other than that, man, activities coming back. Here's the other thing that I think we learned is that rates have to settle somewhere before people really feel comfortable coming out of that woodwork.
Yeah.
So if they bump, 5.875, you'll have a few people that pounce on it that have been waiting for it, and they're going to jump on it. But I think it has to sit at 5.875 or whatever before, for a period of time before people really feel comfortable. I've had lots of scenarios where it hits that low point and people go and they get it, but they don't lock. Yeah. And then a week later, it bumps up again.
They're 6.25.
And they're out. Yeah. And so we saw a ton of deals fall through last year.
Yeah.
I feel like more so than normal.
Yeah.
I don't know how we get numbers on that, but I feel like from an anecdote standpoint, we had more deals fall through last year than I've had in any given year prior.
Yeah.
Maybe I'm wrong. I don't know. But
deals under contract that just fell apart. And I think that's probably right. I mean, just from an inspection standpoint, people had the opportunity to walk away.
Yeah, that's true.
People had the opportunity to negotiate repairs, and sellers could say, yeah, we'll do that, or no, we won't.
Well, and there's still a little bit of a gulf between how I feel as a seller and how I feel as a buyer.
Yeah.
And the really fun part is when the seller's like, oh, no, I'm not paying anybody's closing costs because nobody paid my closing costs. And they're adamant, line in the sand now, right? And then, 3 weeks later, we flip around and we go for them to buy a house, and they're like, well, let's try to get all of our closing costs. And I'm like, well, which is it, dude?
Yeah. You're right. That's funny.
Yeah. So, all right. What else you got going on, man? Anything else to talk about?
Man, gearing up for another big year with the Chamber of Commerce Diplomats. Our retreats Wednesday morning, so that's gonna be a fun year. I know they've got a lot of great things lined up and in store for the Chamber of Commerce. MTSU tennis is about to take off, and it's going to be a fun tennis season.
Oh man, I'm so pumped. Jimmy Borndame was my guest at Table Talk today.
Okay.
And dude,
man, my son's gotten into tennis, and my wife played tennis in high school, so it's a natural thing. She's gotten him interested in it, and Jimmy's been awesome. Like if he sees Anderson out there in the courts, he'll come over and say hey, and just encourage him, and then he'll tell me how Anderson's doing.
Hey, the Hilton is going to make appearances at tennis matches.
I can't wait.
Yeah, it's gonna get rowdy. It's gonna be awesome. I'm gonna throw out a couple of events that we have coming that we have room for sponsors. Cedar Glade Brews is hosting the International Folk Fest this year, the 41st year of Steve Cates' baby there, the International. And so we've got 3 different troops, one from England, one from Poland, and we think the third one is from Czech Republic.
Okay.
So they're going to come do some traditional folk dancing and songs and things like that, and it's going to be a blowout, man. It's going to be a huge event at Cedar Glade. I've got a couple of sponsorships that we need to get. So we've got 6 total that we want to get at $1,000 a piece. We've got a couple folks that have already signed up for that one, including Primis and an F&M Bank over there, Bryan and Grady respectively. And so we're pretty excited about that. But we've got a little bit of room there just to be good hosts for them and get some exposure, man. Bring the kids, see some cool dancing and some rootsy type stuff. So we've got that coming up. That's in June. Man, I had another one. What was the other one? Something in February.
Fudge.
Yeah, well, yeah. We've got the Fudge event at oh yeah, I know what it is. Okay, sorry. So we've got a cool. I like the word gustatory experience. My wife has said nobody knows what that word means.
I don't have any idea.
It's a flavor event.
Okay.
Yeah. So the Silver Fox Treats is taking our beer from Cedar Glade and integrating that into 4 different specialty fudges, some really high end fudge, and we're going to have a fudge flight paired with a beer flight. So you can come in and do that. That's going to be February 3rd. And then the other thing that we've got coming up, I've got to get some sponsors for the Super Trivia Bowl over at Central Magnet. And I have managed to put myself in a position where I'm halfway in charge of that, like an idiot. And anyway, so we've got to raise some money. It's the only fundraiser at Central, and it's going to be a big one. It's a lot of fun. And so anyway, that's March 9th. So if you're interested, if you're a small business person or big business person, whatever, and you're interested in putting some money in some good places, hit me up. Last thing I've got, songwriter competition coming up over at Cedar Glade, also January 21st. Don't need any sponsors for it unless you just want to give me some money. And we've got 16 songwriters signed up. I've got 5 really awesome judges. A diverse panel of experts. And then, ultimately the winner of that, it's a 3-stage competition statewide, and the 7 winners statewide get a little writing contract, they get a guitar, they get some money, and they get to perform at the Bluebird.
That is very cool.
It's super, super cool.
Very cool.
I'm excited about that.
What would that feel like just as a young songwriter to get on that stage at the Bluebird?
I mean, I don't even know. I mean, it would be incredible, right? Yeah. Like religious experience. Yeah. So, Trent, what you got, bud?
Nothing really. Excuse me, nothing really. Just getting my throat clear, but trying to get the year going. Got some new shows coming. Got some new opportunities to connect and make some good content. So we're growing. Got some exciting things on deck. Actually, just got news that we're going to be doing a broadcast for the Special Olympics Winter Games in Gatlinburg.
Heck yeah!
With Nashville Fit Magazine, so that's going to be really cool. Shouts to Terry and the team over at Nashville Fit Magazine. We just kind of finalized that the past couple of days, so I'm super excited about that. So
excellent.
I say we don't have much going on, but we definitely do. So
well, here's the deal. Spread the positive needs your help.
Yes.
Right, and it
always
does. And Spread the Positive is storytellers,
Yes.
right? But the network hosts storytellers. And if you've got a story to tell or you just like hearing stories, then come join us.
Yes.
And there's all kinds of ways for people to fit in, whether it's sitting in this seat behind the microphone, or it's just getting on board and helping spread the word.
Yep.
Writing
Supporting
a
the
check,
shows. Yep.
going out and telling other people to write checks, whatever it is. Spread the Positive is a movement, and it is something that that frankly we need.
Right.
Here's how I know if you're the right person to get behind Spread the Positive. Have you ever said, "Well, there's just not good stuff in the media these days"? If you've ever said that, then by God, we need you.
Wow.
So
Which is like everyone.
Exactly.
Exactly. Come on, man.
So if that's
Come on.
you,
Election year and all the garbage we're about to get into.
Oh my
Come
gosh,
on.
please.
We're about to be a welcomed outlet. For
That's
sure.
right.
So,
Stop being part of the problem and be part of the solution.
man,
Come join us.
Amen. That's it. I appreciate you. Appreciate you both, Bryan. Thank you for your continued support as always, and it means a lot to have both of y'all. Both of y'all in my corner means more than y'all know.
And that's just it. If you need any other reason besides this, Bryan Nale's doing it. You should too.
Come on, be like Bryan.
Be like Bryan.
That's a tagline.
Yeah.
I like Nail Your Mortgage more, but yeah, be like Bryan.
Know your mortgage, be like Bryan. Same thing.
I love
All
it.
right, good stuff, y'all.
All right.
Thank
Well, I
you.
appreciate you. I appreciate you a bunch, and both of you guys. 2024 is going to be a great year. So
That's right.
if you have any need for help with mortgage or just questions or just some clarity or just a cheerleader or a hey pump the brakes guy, call Bryan for sure. If you have questions about your house and getting it ready and all that kind of stuff, and you're gearing up for what should be a pretty wild 2024, give me a shout on that. We'll take care of you. Is that it?
That's it.
All right. Have a great rest of the week. See you soon.